First, though, interest rates are moving higher again. Today, the Bank of Canada hiked its key rate to 4.25%. It hasn't been that high since January 2008. Look at that graph. Remember, the rate was basically at zero earlier this year. All right, to put that in a bit of perspective, take a home that was purchased for $750,000 with a 10% down payment. Back in January, the homeowner with a variable rate would have had a mortgage payment of about $2,500. After today's rate hike, that monthly payment is now at $4,000. But the Bank of Canada, despite all that, changed its tone somewhat in today's decision. So is the worst over? Peter Armstrong is CBC's senior business correspondent, and he's in Toronto. So those mortgage numbers, Peter, bad news. But is there a silver lining here in what we heard today?
Well, you know, we all went into this looking for that silver lining and trying to get a sense of where the bank is. And is it getting ready to sort of hit the pause button and take a look at what's actually happened and give a bit of time for these interest rate hikes to sort of bleed into the economy? Because remember, it takes, what, like 18 months for monetary policy, for interest rate hikes or drops to work their way and seep into the economy proper. So, you know, what we're seeing here, how hard and how bad this is hitting variable rate mortgages and increasingly fixed rate mortgages as they roll over, this is just the beginning. We've got months more of this seeping into the rest of the economy. So we went into this statement this morning from the Bank of Canada looking for signs that it might be ready to hit the pause button. And we found it. You know, it's central bank speak, David, so it's not exactly that they took out a billboard on the QEW to tell us what they're going to do. But they do have language that I think really is worth looking at. The line that has been in the statement for months now has been that the Governing Council expects that the policy interest rate will need to rise further. And that's been the signal that, look, we're not done yet. We need to keep moving. That was even the case in the last one. And we spoke with the Bank of Canada governor after that, and he signaled, look, we're not done yet. We need to keep moving forward. But today, in this statement, it says Governing Council will be considering whether the policy interest rate needs to rise further. That's not, you know, for central banker speak, that's actually a pretty big move. That's quite a statement to come out and be as bold and as clear as that. And yeah, that does signal that they're probably getting ready. If they're not at the finish line now, they're near it, and, you know, early next year we'll be able to hit the pause button. That's rough news still for anybody who was struggling to pay their mortgage bill. You put those numbers in front of us just before I came in. Those were hard to begin with. Add 50 basis points. A lot of people are really pinched. This is cold comfort for them, but it does look like we're getting very close to the end of this tightening cycle.
Right, and the forward guidance does suggest maybe, right? And so because of all of this, I mean, economists are saying that we should all be bracing for a pretty rough winter. I mean, how bad do you think this is going to get?
You know, the economy is slowing, right? The first half of this year, the economy grew by like 3.2, 3.3%. You know, the numbers that have come in for Q3 were better than expected, but still a pretty dramatic slowdown, and that's going to continue. You know, most private sector forecasters are calling for some kind of a recession early in 2023. They say it's going to be mild. They say it's going to be short-lived. But as you and I well know, David, it doesn't take much to nudge a short-lived, mild contraction into something much darker, much deeper, and much longer. And even a short and mild recession is going to sweep into corners of the economy, and people will be hurt. Jobs will be lost. This is going to be a rough winter. But they say we should see some kind of a bounce back in the second half of the year. By then, we should see inflation rates coming back down to something more normal, and we should get back to a more normalized sort of corner of the economy as we move into the end of 2023.
Okay, Peter, always a pleasure. It's the CBC's Peter Armstrong joining us tonight from Toronto. All right, here to dig deeper into the story, Sheila Block is a senior economist at the Canadian Centre for Policy Alternatives. Jean-François Perrault is a senior vice president and chief economist at Scotiabank. Thank you very much for joining me.
Thank you.
Thanks for having me.
Sheila Block, I wonder if I could start with you. This is the 7th rate hike of the year. Do you think, based on what we heard from the Bank of Canada today, it might be the last one for a little while?
It could be the last one. I think some of us were hoping that we would see a smaller rate hike today than we saw. And I think really the question is that the damage has already been done. And we are seeing that in the mortgage rate, in the mortgage payments that you mentioned earlier, and really in the slowdown that we're seeing in domestic demand. And I think more pain to come. So we might be done, or we might see another rate hike, but we're in for troubled times, I believe.
Jean-François Perrault, the same question to you. Do you think this might be the last rate hike Canadians see for a bit?
I think it's certainly the last one we see for a bit, and I'm hopeful it's the last one we see, period. The extent to which that happens, obviously, is going to be a function of what happens to inflation, and to the extent that we observe, a meaningful decline in economic activity, which, of course, is the reason for these hikes by the central bank, right? They're trying to slow things down. And, as hard as has been for some folks so far, actually the Bank of Canada even noted it today that there are signs that the economy is actually stronger than what they'd have been expecting just a few months ago. So there is resilience there, and the bank is unfortunately trying to fight that to bring inflation into line with its targets.
Yeah, Sheila Block, we're in kind of this perverse situation, right? To get good news on interest rates and good news on inflation, we really need bad news from the labor market and bad news from the economy. And you made the point that the damage has already been done. So I wonder if you think this hike was even necessary, because I know there has been a call that maybe this should have been paused a couple of jumps ago.
I absolutely think that more patience was called for and that we needed a pause. We have to remember that really the main drivers of inflation are not sensitive to or subject to the bank rate, and those really are the impacts of climate change, the impact of the Russian invasion of Ukraine, and really the lingering impacts of the pandemic, both economically and health-wise. So, interest rate increases are going to have a limited impact. I think we're already seeing those start very clearly, and I absolutely think a little more patience from the bank would have really been called for at this point.
Jean-François Perrault, what's your assessment of that? That there is a lot of argument out there that supply chains, the war, the oil shock, drought, all of these things are bigger contributors to inflation right now than overwhelming spending. Do you think this was the right decision for Tiff Macklem and his team today?
Listen, I do think it's the right decision. Now, it's clear to the point that you're making that a lot of the inflation that we've seen is global in nature. It's reflecting things that the Bank of Canada can't really impact. But what we know, though, is that those things have impacted inflation expectations. Those have a big impact on how people perceive inflation. We also know that some of the pandemic support programs, as impactful as they were, and they were very helpful in terms of bringing us out of the pandemic, did create more demand than otherwise would have been the case. We're of the view that, the 50 basis point increase that was done today was I think, what the economy needed, unfortunately. But we're hopeful that with this move, we don't need to do any more. And I think that's really the kind of the challenge that the governor is trying to manage here is, doing enough in the short run, knowing fully well that this is going to take a while to fully work its way through the economy, but doing enough now so that he doesn't have to come back at a later point in time and realize that actually, they didn't do enough, right, and they need to kind of tighten much more aggressively later on and amplify the weakness that we, to some extent need to bring inflation down.
I wonder if I can just pick up on the point you raised there about the government's pandemic spending. There was the Auditor General report about that yesterday, and the opposition Conservatives have been citing the work of your bank as proof that the pandemic relief bills were a real core driver of the cost of living crisis and the inflation that the country is seeing. Is that an accurate description of what happened? Because the numbers in your assessment shows it was a factor, but by no means the overwhelming one. Am I reading that right?
No, absolutely. You're absolutely correct. We think obviously the pandemic support programs have an impact on economic activity. They wouldn't have done them otherwise, and we wouldn't be talking about them otherwise. But the impact on inflation has been relatively minor. In the greater scheme of things, there are a broad range of factors that had far more impact on inflation in Canada and around the world than the support programs that were rolled out during the pandemic.
So Sheila Block, I wonder if you take any hopeful signs from what we saw today. Inflation is still at around 6.9%, but there is talk of core inflation being lower at around 5% in the 3-month rolling average. Not to get too technical, but it shows that maybe we're into a slowdown phase of inflation. So as tough as a 50 basis points rate hike is for people, is there a silver lining in this pretty dark cloud for variable mortgage holders?
Well, I think the silver lining is that there is this slowdown, but I think we have to be really clear that inflation has a really different impact depending on your income levels. And what we have seen is food inflation, the cost of food. We've seen rent, gas. All of those have paced above the overall CPI rate, and that is really going to have a tough impact on those lower income people who spend a larger share of their income on those essentials, and also people who don't have that kind of cushion to ride this out.
So Jean-François Perrault, I wonder how long do you think it takes to get to the 2%? I think that the phrase they use is that we are resolute in our commitment to achieving the 2% inflation target and restoring price stability to Canadians. I mean, how long do you think it is before we get to that point?
Oh, we're quite some ways away. You know, we're thinking in terms of our own forecast, sometime in early 2024. So we're not nearly there yet.
So do you think rates decline up to that point, or we hold at this level and then it starts to come down in early 2024?
Yeah, I mean, our hope and expectation is that we kind of stay at this rate for 3 quarters. So, and that by this time next year, we are in cutting mode, gradually cutting the rates back down to a level that is more neutral for the economy, which is in the 2 to 3% range.
Sheila Block, do you agree with that assessment, or what's your take of the road ahead on these issues?
I think I would agree with that it's going to be a long road. And, you know, we have been hit by so many surprises that have sideswiped the economy over the last 3 years that we really don't know what might come up and what impact that might have. But I do agree that if no other surprises come, we should be able to move down to lower rates in about a year. But that's a long time, not only in politics, but in economic life as well.
Look, I think if there's one thing we've all learned since March of 2020 is don't bet on futures. Like, who knows where these things are going to go. But listen, thanks so much for both of you for walking me through the intricacies of today. Sheila Block and Jean-François Perrault, thank you very much.
Thank you.
Thank you.